still say it's very, very uncertain.
What's going on? Read between the lines for me here. What is actually happening?
I think, in a way, the Saudi stance has changed a bit, just so that we see a bit of a stabilization in markets. They fear that, especially after IP week in London just last week,
that so gloomy.
Yeah, given the gloomy picture on demand as well, that to really get a price floor, so as to say, at these levels, they do need to do something. And I guess the other producers, Russia, etc., agree with them as well on that point. But again, although the market was looking for that grand bargain moment from the supply side, all we've got is something which is a non-event, essentially.
Do the Saudis feel they're winning the war in the States, though? You look at the rig count down sharply, you look at the stress in the banking sector.
So that's possibly why they would have agreed to freeze at least, or they're probably warming up to the idea of a freeze, because they know at $30 a barrel you are starting to get the damage in the non-OPEC side. I mean, as you said, the rig counts are showing the data starting to weaken. Production will start seeing, softening as well come the next 1 to 2 months. But I think the other angle for oil at the moment is as well demand. As much as demand was a growth story last year, this time it's looking a lot lackluster. US oil demand's looking softer than it was last year, both on gasoline and diesel. That's a worry as well. So,
okay, let's talk about market positioning. Has this deal, though, reintroduced the idea of two-way risk into the oil market? The fact that they are talking, does that, if you're on the margin of putting a short on, does that start to change your thinking? Yeah,
the risk rewards for a short at the moment aren't as compelling as before. And to be fair, I mean, we've been having stretched positions on the short side, and WTI more so than Brent, given Cushing's, where stocks are very close to
breaking storage.
Breaking storage. I think the excitement with which shorts were piling in would definitely not be as much.
So does this reduce the volatility? It was interesting having a chat with Goldman Sachs. So this doesn't reduce the volatility?
We don't think the volatility is going to decrease. It's just a very unstable equilibrium. The market's grasping in the dark for data points, for signals from producers such as Saudi Arabia, etc. And the volatility is just here to stay.
And is that down to the storage story as much as anything else? It was interesting, we were talking to Goldman's about this, and their view is we've broken storage, Cushing, as a result of which you start to get a lot more price movement surrounding that. Yeah,
so it's a tale of two different basins, so as to say. So in the US, we're having the storage issue now, and that's why WTI time spreads are widening. And as you know, Cushing's at close to 63, 64, we can touch up to 73 million barrels, and now that US refineries are now paring back on their runs, given economic margins, demand's falling, their margins are falling, etc., we might see that speed up, essentially. On the other side, the other basin, which is Brent and the international grades, their spreads aren't that bad. I mean, 65, 70 cents per contract suggests that onshore storage still is available on the international scale, although most of them are brimming, but not as critical as in the US. So it's a tale of two crude grades.
Let's talk about the dollar. PPP suggests we should be at 131 euro dollar, i.e. we should be significantly higher from where we are now. You get a weakening in the dollar, and it was interesting listening to Rosengren last night, you look at the work function on the Bloomberg, 0 rate hikes priced until the front end of 17. You start to see a weakening in the dollar. How does that change your model?
It changes from a few perspectives. So if we are not seeing further rate hikes, it possibly means EM currencies may get a breather. And these countries that are importing crude, such as India, Indonesia, etc., also get a bit of support from the currency side. So the demand side helps. The supply side is interesting because a stronger dollar means that other producers, such as Venezuela, for instance, or Russia, etc., their cost of production gets insulated because they're selling in dollars, and their costs are in local currency. So that changes the dynamic in a sense. So I think the fact that we may not get the extended dollar rally as before because of the rate hikes now, at least the market pricing, and nothing for this
Market's never wrong.
It could help oil to an extent. as a supporting factor. But again, we see these correlations between oil and the dollar come on and off.
Yeah.
And typically we see the strongest correlation between oil and the dollar come through when demand is a concern.
Right.
But whereas when supply is back in the driving seat again, we see the correlations break down. So we're somewhere in the middle at the moment. A few weeks ago when demand was a concern, the correlations were strong. And now, again, the supply side stories are getting more headlines.
That's really interesting.
Yeah.
Cool. Thank you very much. Such a great amount of ground covered. Miss Wynn, thank you very much indeed, Mr. Mahesh, oil analyst at Barclays. Up next, we've heard of The Big Short. You've probably even seen The Big Short. Well, how about The Big Long? We'll bring you the story of traders who made a killing by buying